may have heard that the VIX is the gauge of fear in the market, but how do you really use that to make good trading decisions? Our guest today is Dan Passarelli, who's here to talk about that. So Dan, first of all, what does the VIX measure?
The VIX specifically measures the implied volatility of the options on the SPX, which of course is the index that represents the S&P 500.
All right, so if I'm watching VIX on a daily basis, as a lot of traders are these days, how does it help me make better trading decisions?
Well, whenever you trade options, you're trading implied volatility. Implied volatility measures how cheap or expensive the options are. So if you're an options trader, that must be one of the indexes you're watching. You know, if all you do is trade stocks, what's one of the first things that you're going to look at every morning? You're going to look at the Dow Jones or the S&P 500, or probably both. If you're trading options, the profitability of your option positions is affected by the market as a whole, and of course the underlying individual stocks. But you also care about how expensive or cheap the options are. So therefore, just as even if you're not trading the S&P 500, if you're trading an individual stock, you still look at the S&P 500 as just a gauge to get your bearings on the price of stocks. Well, you look at the VIX to get your bearings on the volatility of the market collectively in the similar fashion.
All right, so let's talk more recently about what's going on in the market. We've seen quite a bit of price action coming down, and yet the VIX has remained relatively flat. And you would think that a lot of movement to the downside would increase that VIX as fear increased in the market. Yet we haven't seen it. That's concerning in of itself, do you think?
It is. It's really interesting to watch. That could indicate a little bit of complacency in the face of what is maybe a market scenario that doesn't warrant complacency, which could could kind of mean be a little bit of a bearish signal.
So do you feel like we're headed lower here into the rest of 2011?
I don't think we're headed too much higher. I mean, we've been in a little bit of a channel. It's been a very volatile channel, and right now we're kind of at the cusp of perhaps breaking through. I think there might be a little bit of room to the downside, but I think ultimately I'd be surprised if we move more than 4 or 5% from where we are now either way.
All right, so knowing that we might be in a range and it may only be 4 or 5%, give us an idea of maybe a trade, a spread, or something that we could maybe profit from if it doesn't go very far in either way.
Right. Well, because implied volatility is higher than it historically is, although arguably maybe not as high as perhaps it should be, a strategy that has been working well, if you've been able to time it well, is to sell put credit spreads when the market is at its lows, and then when it reverses course and goes back to the top of this channel that we've been in, then leg into the other side of what we'd call an iron condor and sell the call credit spread.
All right, talk about what the put credit spread is.
Sure. A put credit spread is when I sell a put that's out of the money, and then I buy a lower strike put for protection. But your potential profitability comes from that short put, but that's also where your risk comes from.
Dan, thanks for your time.
Thanks.
You're watching the MoneyShow.com video network.